Good morning, friends. Myself, Prasanna Kolgiri from Sholapur. Today, we are going to have a discussion, a very interesting topic equity, the long term wealth creator. Before going into depth with this topic, I like to share some facts and figures of holding patterns in Indian companies by foreign investors. The foreign investors holding pattern is almost 60 to 70% in Indian companies. Means what this mean to us? All the hardcore money which is earned by our CEOs is moving into the pockets of foreign investors. Still, the economy is dominated by the foreigners. We have to change this pattern in making retailers more participating in equity market, in ULIP, as well as in mutual fund. So let us start with our topic equity, the long term wealth creator. How it is? Let us take into consideration a person who regularly invests in fixed deposit with a rate of interest 10% for 5 years, 10 years, 15 years, and 20 years. The investment is 1 lakh rupees lump sum. For 5 years, it will fetch 1.50 lakhs. After 10 years, 2.60 lakhs. After 15 years, it is 4.70 lakhs. After 20 years, it is 6.70 lakhs. Now, if he is having a trader type of mentality and compounding in what he will be getting a return on investment of 1 lakhs. After 5 years, 2.50 lakhs. After 10 years, 6.20 lakhs. After 15 years, 15.40 lakhs. After 20 years, 38.30 lakhs. Now, if he is an investor and compounding 30 percentage he gets, when he is investing only 1 lakh rupees, after 5 years it will be 3.70 lakhs. After 10 years it will be 13.80 lakhs. After 15 years it will be 51.20 lakhs. And after 20 years it will be 1.90 crore, means 2 crores. The investment in fixed deposit for 1 lakh is 7 times. The investment of 1 lakhs in trader, it is 38 times, and the investment of 1 lakh in investor pattern is 200 times. See the beneficial of investment in stock market. Which point we have to take into consideration before investing in a stock market? Mostly we are very ambitious person, a middle class family, like everybody's reason of investment is mostly for child education, child's marriage, housing, for retirement, and for the safety income to be flow. So everyone has a one or more of the above reason to be invested for. How we have to invest? We have to start earlier, do not time the market, prudent asset allocation, invest regularly in the form of SIP or STP, understand the risk reward ratio. See that stock 30 percentage. 1 lakh he has invested and he is getting 2 crore. The risk reward ratio. And have a set of investment objective: child education, housing, retirement. Friends, you might have heard seven wonders of the world. But in front of you, I am bringing the eighth wonder of world, that is power of compounding. With this topic, we are going to deal with few topics like value of money, inflation, how money gets eroded, why you should start investing earlier, and why you should invest in stock market, ULIP, or in mutual funds. Let us see. First of all, ensure your financial goals, whatever it is. Now let us see the points which I have told you one by one. The first point is value of money over time. I like to ask y'all only, what's the monthly expenses of your household? Some may say 15,000, some may consider as a 20,000. I'll take into consideration 20,000 today if it is your household expenses, and the inflation rate is 10% per annum. After 5 years, the monthly expenses of yours will be 32,210. After 10 years, the monthly expenses of your household will be 51,875%. After 15 years, it will be 83,545. After 20 years, it will be 1,34,550. So, I've taken into consideration inflation of 10% only. Means the expenses which is there at present 20,000 will become 1.34 lakhs after a period of 20 years. Now, how money gets eroded? Let us see. The same example, you have 1 lakh rupees and you have kept it in your locker. After 5 years, the money valuation will be 59,049. After 10 years, it will be 34,868. After 15 years, it will be 20,589. And after 20 years, it will be 12,158. Means the value of your 1 lakh will remain 12,158 after 20 years. This is the impact of inflation which is there. And right now, we are suffering from inflations. I'll give you one case studies also for long-term investments, but pay regularly to achieve your financial goals. Means you have to invest in SIP form or regular premium or in the form of STP or in the equity at a particular date and time. It's better. It's not the timing, but the time in the market which matters a lot for us. Now let us understand the eighth wonder of this world, which is power of compounding. मराठीमध्ये त्याला चक्रीव्याज म्हटलं जातो. Let us take an example of a person is investing 1,000 rupees every month at the rate of interest 8% per annum. The principal amount after 5 years will be 60,000. The amount with interest, चक्रीव्याज जे म्हणलं जातो, will be 73,967. If you take into consideration for 10 years, the principal amount will be 1,20,000 and the amount which he will be getting is 1,84,166. And after 15 years, the principal amount which he has invested will be 1,80,000. The amount which he gets is 3,48,345. After 20 years, the principal amount which he has invested will be 2,40,000, and the amount which he will be getting is 5,92,947 rupees. You might have gone to Mussoorie, Simla, or Jammu and Kashmir. You might have played with a snowball also. If you throw it snowball, it gathers masses around them. So in this way, the power of compounding is gathering mass around its principal amount. How you find it, friends? Very interesting, no? Power of compounding. Let us take another example, that is why we should start earlier saving at the age of very young. And that too, if you are not married, if you start earlier, it's very fantastic one which is there. I've taken two example, a person called as a person called as B. The person A age is 25, the person B's age is 35. Both of them are going to get retired at the age of 60. And they are investing 2000 rupees every month. And the rate of interest they are going to get is 8% per annum on a monthly basis, compounding basis. The principal amount which has been invested by A is 1,20,000, and for 30 years with power of compounding, the amount will become 14,83,610. And the same person B, he has also invested his principal amount 1,20,000, but after a period of 20 years, it will become only 6,89,520. See the gap. And what make a difference within 10 years, you can see, you can observe it from these figures only. And I've taken it into consideration only 8%. You can imagine if it is taken into consideration the figures which we are going to have a discussion in further. How can reduce this risk of losing money? I will try to demonstrate in next few slides that it is possible to reduce the risk of investment, equity, ULIP or mutual fund dramatically very low level. Means from high risk to low risk, and almostly it becomes to zero also. So let us look following facts and figures. Already you all know BSE, Bombay Stock Exchange. In that there is one index called as Sensex. All top 30 companies are there in Sensex. We purchase Sensex only and hold it for a period of 1 year, 3 year, 5 year and 10 years. And we sell it this holding at respective period. Let us see what's the return we are going to get it. Oh, just a second. Let us see what we are going to get returns from these assets. The first one which I have taken into consideration is of Sensex. Figures I have quoted in percentage over a period of a time, average, maximum returns and minimum returns. And within first year, the average return will be 19% and the maximum return will be 93% and minimum return will be minus 53%. After 3 years, the average return will be 70%, maximum return will be 300% and minimum return will be minus 40%. After 5 years, the average return will be 160%, maximum return will be 573% and minimum return will be minus 31%. Similarly, on 7th year, 239% average, maximum return 496% and minimum return is 20%. Likewise, after 10 years, 289% average and maximum return 454% and minimum return is 160%. See this table. First year, it's minus. Third year, it's minus. Fifth year, it is minus. But see, in seventh year, the miracle has happened in Sensex. Negative has converted into positive. 20% is return. See, after 10 years, the person is getting 160%. The data which I have taken into consideration is July 1997 till March 2010. The data which I have taken into considerations. Now you have seen in Sensex or you have seen in Bombay Stock Exchange. Will you like to see in National Stock Exchange also? And that too also the index which is most famous, Nifty 50, is worldwide most traded one. Yes, you like to say. The first year the average which is there is only 21%. Maximum return is 244% and minimum return is minus 52%. The third year it is maximum 58%. Average return is 58% and maximum return is 297% and minimum is minus 36%. Fifth year, the average return is 99%, maximum return is 520%, and minimum return is minus 27%. Seventh year, the average return is 132%, maximum return is 437%, and minimum return is minus 29%. After 10th year, the average return is 180%, maximum return is 469%, and minimum return is minus 10%. After 12th year, the return which is there, average 236%, maximum return 576%, and minimum is 40%. After 15 years, the average return is 464%, maximum 855%, and minimum is 105%. Similarly, after 17 years, it is 757%, maximum return is 1755%, and minimum is 139%. Look at these figures. Minus, 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 minus. See, the high risk is slow, steadily is getting reduced. Almost it has came in 10th year, 0. From 12th year, you can see the return, absolutely fantastic one. The data which I have taken it from Nifty, July 1990 till March 2010 it is. So, in Sensex, on 7th year onwards, the holding, you will be getting maximum returns. In Nifty, from 10th year onwards, you will be getting maximum returns in Nifty. So, the risk of losing money significantly decreases if we increase the time for which the investment is made, and actually becomes zero on the data shown on Nifty and Sensex over the period of time. But if you take into consideration the average return from the Sensex and Nifty for the period of last 20 to 30 years has been around 15% CRGA. And there are so many benefits. Now we have compared only with other asset cards with returns. Now let us compare with another like tax slabs with equity as well as fixed deposit, golds and properties. Equity, ULIP, section 1010A, no capital gain tax. If directly in stock exchange, after a period of 1 year, there is no tax. But in FD, it is taxable. In gold, physical gold, it is taxable, but it is if it is in ETF, no. Property, it is a taxable according to the slabs 10, 20, 30. unless until it is reinvested. So these are the taxable slabs which are there. So to summarize, we have learned from the model that equity is a long-term wealth creator. Now, I like to give some highlights or some hints or tips for the renewal of premium of ULIPs, which your colleagues have sold these products or you might have sold this product. Initially, it finds negative, but highlight power of compounding as well as highlight the Sensex 7th year onwards, highlight the Nifty after 10th year onwards, show them facts and figures. You'll be getting a regular premium in this fashion also. So the probability of losing is very less if our customer stays for longer term in the policy. So friends, this is the way of investing in equities, ULIP, as well as in mutual funds. Long term, it's a wealth creation. The examples which I have shared with another class of assets which are there. But I like to share with you all one fact which शायद आप भी जानते रहेंगे कि आपके जीवन में कोई रिलेटिव काम नहीं आता, कोई फ्रेंड्स नहीं काम आता, कोई भाई काम को नहीं आता और कोई नियर एंड डियर्स काम में नहीं आता जब पैसों की बात आती है। तो शायरी इस तरफ है सर, इस तरह से जीवन के किस्मत के घड़ी में कौन किसका होता है, जीवन के किस्मत के घड़ी में कौन किसका होता है, परछाई भी साथ नहीं देती जब अंधेरा होता है, जब अंधेरा होता है, परछाई भी साथ नहीं देती जब अंधेरा होता है, अंधेरा होता है। Thank you friends. If you like it, press this button and please subscribe my channel. So thank you friends for watching this video.